super excited to have Paul Chano here, who is coming from Tax Planning Boutique, someone that I've worked with closely for a long time. And this is a topic that is so important because, as doctors, we all know and feel it, taxes are our number one expense. And we're probably feeling it especially acutely now, as our taxes are either about to be put in or maybe already have been put in. We're seeing how much we're paying, and there are a lot of proactive things that can be done. This is certainly one area of finance where, if you try to DIY it, in general, you'll leave money on the table because a lot of this stuff is very complex, and you want to work with people who are really truly experts in this, like Paul and Lubna are. So with that, I'm going to turn over to Paul, who has an exciting talk for us and also some really cool hands-on real life case studies. And there will be plenty of time at the end as well for Q&A. So if you do have questions, please feel free to throw them in the chat whenever, or if you want to wait till the end, or even if you just want to put up your virtual hand and I can have you do it live. This is a prime opportunity to talk to truly experts in this really important topic area that I find most physicians are under planning, underutilizing strategies in. So with that, Paul, thank you for being here, and I'll turn it over to you.
Thank you, Jordan, and thank you to the Prudent Plastic Surgeon team for having us on today. Hi, everyone. My name is Paul Chano, and I am a tax planning strategist. I am licensed as an enrolled agent, certified real estate tax strategist, and certified tax and business advisor. We also have Lubna Chano, the founder of Tax Planning Boutique, who is a tax planning strategist as well, a CPA, a certified tax specialist, a certified healthcare business consultant, and much more. We hope everyone had a happy Easter, and we're happy to be back doing another presentation for the group. If anyone has seen our webinars before, we've talked about real estate tax planning, updates from the Big Beautiful Bill, and what exactly tax planning is compared to tax preparation. Today, we're happy to branch from what tax planning is and to go more in depth of exactly how we look at a physician who is a strong candidate for tax planning. As many physicians here, I'm sure can relate to this, as Jordan mentioned, taxes are most physicians' number one expense. And in the past, we've talked about how tax planning can financially defend you from this massive expense every single year. What we will do differently today is instead of handing you a long list of tax strategies and tell you they exist, what we will talk about instead is how Lubna and I actually read a tax return with a tax planning mindset and see what is missing, what the tax return is telling us, and what it means for you specifically as the taxpayer. We will go through what we see on the 1040 individual tax return, as well as the corporations and partnership tax returns, and give some examples of what we've seen and what we think about. Then after that, we will look at two case studies of real high-income physicians who are our current clients and have been our clients for many years. We will talk about what their situation was like before hiring us, what we implemented for them, and finally, the tax savings we achieved for these physicians. We'll also have some time at the end for questions. There's no such thing as a bad question when it comes to how to pay less tax. As we all know, tax law is very complex, and we want to be able to help you understand what your options are when it comes to saving money. With that, let's dive in. So as I said, if you've watched one of our previous webinars, you know that we have a consultation process called the tax discovery session, which I will go in detail about at the end of the presentation on how to schedule. But in order to know how to get tax planning, you have to know what opportunities you're missing out on that can apply to you. We typically review the most recently filed tax returns, financial statements, and your financial goals, and other information depending on who you are, so we can be able to get a pretty good idea on what you're going through right now in this moment, and more importantly, what you will go through in the future. We always start at the 1040 individual tax return. For purposes of tax planning opportunities, we're not primarily focused on compliance. We're looking for what you could have done differently. To be clear, compliance is very important, and that's what we also provide for you. But the tax discovery session isn't just a session to tell you that you put the right numbers in the right boxes and on the right forms. We want to tell you what tax breaks you may have qualified for because you're a business owner or because your income is so high that there are ways to mitigate your tax bill. So at first, We look at the total income and wage amount or the total W-2 amount to get a good idea of where you're at. When it comes to wages, we want to know what you made last year and get as close as we can to the exact dollar amount you'll make this year. What we look for is what limits exist based on your income level and how you can work around them. For example, you may have heard of the SALT cap, the state and local tax deductions. If you happen to qualify for the workaround, if you have a pass-through entity or you qualify to set up a pass-through entity, um, this can avoid the deduction cap and lower your income level at the business level. This is especially great if you live in a high tax state like California or New York. The wage income level can also determine if you qualify for some charitable donation tax strategies. We don't look at how much in donations you made, but really we look at how much you could donate in a year. Then we'll flip to two different pages to check how your business is doing. That is the famous Schedule C and the second page of the 1040. We look through your Schedule C to see what you're not taking as part of the core tax breaks most business owners who profit well could qualify for. Some core tax breaks could be some depreciation strategies, retirement, hiring your family members, taking a home office, and some healthcare strategies. However, the planning on Schedule C is much more limited rather than having the possibility to set up a corporation or a partnership, depending on who's involved with you in your business. On the 1040, we look at a particular line to see if you're paying additional taxes like the painful self-employment tax. This leads us to think if you've ever considered setting up a corporation, whether that is an S corp or a C corp. We see many physicians who have 1099 income and they report this income on this form, but they have no idea what to tell their CPA when it comes time to summarize their business expenses. This leaves them vulnerable to not only the higher income taxes, but also the painful self-employment tax. Physicians typically think, okay, well, I have my supplies, my software, my continuing education, and probably some contractor expenses. But they don't think, did I work from home? Did I use my car? Did I set up a retirement account? Or should I set up a retirement account? Did I take advantage of hiring some of my family members? Physicians like you are experts in your particular medical field, but we don't expect you to know exactly what possible tax breaks you're subject to as a business owner. That's what we do. We print out these tax forms, and we take our pen and we circle every single line item with a question mark and write down in our notes, we should ask him this, or we need to see if she qualifies for this, or why didn't you do this last year? After looking at your business income, we'll look at your capital gains on Schedule D and your dividends on Schedule B. This could be from receiving dividends from your C Corp, selling a business, selling stock, or selling rental real estate. Once the sale has happened, unfortunately, there's only a certain amount you can do to change anything. But if you're preparing for a sale, then that is something we can provide some advice for that can help you reduce your taxable income from the sale. When it comes to looking out for C corporation dividends, we want to know how much money is coming out from your C Corp because this typically leads to a double tax of your money. One level of tax at the corporate level and another level on this tax return, the individual level. Now, there may be a really good reason for that. We are not against C corporations. This will lead us to open a conversation with you and ask, why are you a C corp? Because there can be very good reasons to being a C corporation. Maybe you're planning on a sale and you qualify for the exemption from tax on the sale. Maybe the tax arbitrage makes sense in your case. Our policy when it comes to picking which corporation you should be is to carefully consider what you need and what each corporation can offer you. Maybe you can have both types of corporations to take advantage of benefits in both entities. We have a client who's a dentist who is also an educator. His main practice is in an S corporation, but we also set up a C corporation for him because there are benefits called fringe benefits, where the shareholder of the C corp can take advantage of tax breaks that are specifically not allowed for S corp shareholders if they are solo shareholders, like many solo physicians. The next form we look at is your Schedule E, which shows you all rental properties, royalties, and your K-1 investments from partnerships and S corporations. If you have a rental property, the main thing we look for is depreciation, which I'm sure we can all agree is our favorite type of loss because it's not really a loss, it's just a paper loss. Each rental property has something called a depreciation schedule, where the depreciation history of your rental property is documented from the year you first bought the property until now. This is one area where tons of money is left on the table, but it may not be too late to save all of that depreciation and use it in a future year. We actually just helped a big real estate professional who has a big portfolio of rental properties in the Chicago area save over $250,000 in taxes saved because his prior CPA was not implementing these real estate tax planning strategies. When we reviewed his tax return, it was obvious to us once we looked at his depreciation schedules for each property. There was nothing wrong from a compliance perspective, but with a tax planning mindset, we were immediately able to look at the form and flag this as a missed opportunity. What most people don't know is you can always catch up your depreciation if you didn't take it in the past. There's definitely a cost benefit analysis that has to be done, which we do for you, and we have to consider whether you had the potential to have those losses be considered active loss instead of a passive loss. Speaking of passive losses, the next form that we look at is if you have any carried over passive losses, which is on a separate form on your tax return if you have these losses. These type of losses are carried forward indefinitely until you sell your real estate property. Planning for a real estate sale is almost in line with knowing how much stored up passive losses you have over the prior years of owning real estate. And now that we're talking about carryovers, we also look for other carryovers you have because that can massively help you plan for the future. For example, if you have tons of capital loss carryovers and you're planning on selling something for big capital gains, those carryovers over the years can massively help offset your gain so you can enjoy your proceeds with as little tax as possible. This can also help you with real estate sales to a certain extent. Other carryovers we look at are charitable contribution carryovers. Sometimes people donate more than the yearly limit based on your income. These can be carried over or carried forward for 5 years. If you have transitioned to multiple CPA firms over the years, there may be a chance one of them forgot to add in your past carryovers to the tax year you filed with your new CPA. It's a big waste to not use these carryovers. I think it's helpful to know that when we think about what tax strategies to implement, tax planning impacts you overall. This could be benefits across multiple tax returns, such as your corporation tax return and your individual, or your partnership and your individual, or even connecting the partnership, the corporation, and the individual tax returns. We don't have a mentality of looking at one form and seeing what you can do on this one form. Oftentimes, we do something on one form or on a separate tax return, and based on the flow of the tax returns coming together, you are benefiting overall. We'll talk about this during the case studies. With individual tax returns out of the way, we now have business tax returns to look at. So let's start with corporations. This could be an S Corp or a C Corp with a couple of nuanced exceptions for each entity. We first start off looking at the front page of the tax return, and this will tell us the following. Gross revenue and compensation of officers. One of the most common mistakes people make is setting their salary too high where you're paying extra in payroll taxes or too low, which could subject you to an IRS audit. Oftentimes, when physicians see that they are paying too much self-employment tax on Schedule C of the 1040, they elect to be an S corporation. This doesn't necessarily solve all your problems. If you're a physician who's making tons of money, the IRS will want to make sure you're paying a fair amount of payroll tax on your salary, or a reasonable amount. But where physicians mess up is they are limiting how much they can contribute to their own retirement plans, which we bring up when reviewing the pensions and profit sharing. Next, we'll look at rents. Many of us have heard of the Augusta rule, which allows you to rent your home to your business if your business is a corporation or a partnership. This is actually a very complex tax strategy, and it is not as simple as you may think. There are actually plenty of audits that happen when people don't implement this strategy correctly and don't have the proper defense to an IRS audit. But what we look out for is if you even took this strategy. If this line is blank, we take our pen and we circle this line so we can bring it up and talk to you about it and determine if you qualify for the strategy. If you want to learn more about this particular strategy, you can pick up my new book through Amazon called The Ultimate Tax Lock. This book is a tool for you to beat the IRS in your tax audit. One of the chapters in this book is the Augusta Rule, and in this chapter contains the black letter law, an interpretation in English for the physicians, not legalese, instructions on how to take this deduction, real-life tax court cases on how taxpayers lost in court when claiming this strategy, and most importantly, log entries so you can document this strategy throughout the year so you can use this in your defense just in case you get audited by the IRS. There is a special discount for the prudent plastic surgeon audience. I will bring that up at the end of the webinar. Next is taxes. This may sound like there isn't much to do, but based on my previous slide where I talked about the SALT cap, the state and local tax deduction limit workaround, this is actually where this strategy is implemented, also with the applicable state tax return if you qualify for the strategy. With this strategy, we consider the state that you're living in and determine under the state tax laws if this is reasonable for you to take advantage of. Again, this is one of those strategies where this is implemented across multiple tax returns and leads you to pay less overall. We then look at pensions and profit sharing, which can help you set up your own retirement accounts and take advantage of contributing to your own retirement account and take a deduction for it, which is separate from the normal pre-tax deductions that a regular 401k will give you. If you're big on saving for retirement, this is a great strategy that we can help you with. When it comes to strategies like these, oftentimes it takes more than one advisor to implement. In this case, that would be us, the tax planning strategists, and your financial advisor who may be managing your assets, such as your retirement accounts. We take the liberty of working directly with your other advisors so you're not caught in the middle as the messenger to help you focus more on your work as a physician. Now, going off of the first page of the tax returns, we look at what fringe benefits you have or have not taken. This could be healthcare benefits, insurances, and other employee-related benefits that are typically applicable to C corporations only. Then we'll look at the balance sheet on the tax return. Many physicians don't realize that besides your balance sheet that you maintain in accordance with your bookkeeping, there is a balance sheet for tax purposes that is reported on the tax return. And that is if your income reaches a certain level. This tells us what your assets are, and more importantly, what your equity and liabilities are. To give you an example of how important this is on the corporation side, we recently had a new client with a $1 million as a liability loan to the shareholder. We asked him what this liability is, and he had no idea and didn't know that his prior CPA was showing loans from shareholders in order to be able to deduct his losses. So this is one of the red flags we look for on this page. We ended up coming up with a plan on how to remedy the liability so that this doesn't trigger any IRS audits. Finally, we want to see what your stock basis is in your corporation. This is very important, especially for S corporations, because your basis is what allows you to take losses and flow those losses through to your individual tax return. The concept of basis is basically your skin in the game. And the tax rules say that if you don't have skin in the game, then you can't take a loss. We commonly see this when physicians take too much distributions from their corporation without thinking about the future. That's what we plan for. Now, if your basis is very low to the point where you can't take losses if needed, we will help you set up a plan to build your basis back up, which could be across the span of a couple of years, so that in the future your corporation is healthy. Physicians don't realize that if you take distributions when your basis is $0, that can subject you to capital gains tax, which you definitely don't want to pay. Next, with partnerships, we look at very similar things as the corporation side, but there are nuances with partnerships that don't typically apply with corporations. It is very popular to hold real estate in a partnership if you, as a physician, are partnered with other physicians in your office. The most common for physicians is holding the medical practice building in the partnership. Some physicians, as a side gig as well, also hold rental residential real estate in partnerships if they have some partners. There are big tax strategies that you can take connecting your physician practice and this real estate building so your losses from the partnership are not considered passive. This is a huge missed strategy that we look out for. Similarly, with the corporations, we look for the balance sheet on the partnership tax return, mostly for the assets held, such as real estate, so that we have an idea how much value you have in your property. We also look at the depreciation schedules on this tax return, similarly to the Schedule E as I talked about on the last slide. And finally, we also look at the partnership basis similar to the S corporation basis. Now, leaving the tax return, depending on who you are and how you make money, we will ask to review the following for you. If you own a medical practice, we will ask to see the revenue cycle, which is the back-end revenue for the medical practice. If you're a partner or a shareholder in a larger physician group, we like to review the RVU calculations, where we will review your production percentage amount to make sure that the calculation is correct. We'll also like to review the profit and loss and the balance sheet financial statements per your bookkeeping. When it comes to insurance, we always just ask if you have insurances like professional liability, disability, embezzlement, etc., just to make sure you're covered, because these are also tax deductible for your business. We do not sell any insurance, just to be clear, but we always just ask in our discovery sessions. Most importantly, we want to know your financial goals for the year or years ahead. This impacts our willingness to suggest a particular tax plan. Some tax plans are done with a minimum commitment across multiple years. This can affect the cost-benefit analysis of whether the tax strategy is really worth it, depending on what your goals are. So now that we know what to look out for and what the potential opportunities are, let's move on to our first case study. In this case, we helped a cardiology group of 5 physicians pay substantially less in tax. These physicians were all equal shareholders of a C corporation, which controlled the cardiology group itself. The physicians were holding their shares in their individual names only. The way the C Corp tried to minimize their tax bill without tax planning was trying to zero out their corporate taxable income to prevent the double tax. As you know, as I mentioned, C corporations have their own corporate tax rate of 21%. Typically, after the C Corp pays salaries and expenses, the remaining profit is supposed to be taxed at 21%. Well, one of the ways the C Corp tried to get around this was to inflate each physician's salaries, which subjected each physician to a very high W-2 income and therefore prevented the physician from deducting expenses that each physician incurred to lower this income. Inflating salaries for C Corp shareholders is actually one of the items the IRS looks for because they will want the C Corp to pay the corporate taxes. So this method led to the C Corp getting audited for this almost every year before hiring us. For one physician, not the whole group, this one physician's tax bill in 2018, which was the year prior to working with us as Tax Planning Boutique, his tax liability was $396,029 for both federal and state before considering any withholding. Imagine what the entire tax bill was for all the physicians in this group. Each physician was going through this every single year, paying around $400,000 every single year, thinking there is no way to escape this massive tax bill. But luckily, these physicians came to Tax Planning Boutique. This group approached us and we reviewed their situation. We not only saw massive tax bills, but we asked them, how are your insurance policies for disability and professional liability? These physicians, who again are cardiologists making tons of money, had zero disability insurance. The entire group had professional liability insurance of $300,000 total for 5 physicians, which is a disaster waiting to happen. Also, they had no insurance to protect themselves from embezzlement in case someone on their staff decides to do that. These doctors were in a really bad shape. Not to mention, in their personal lives, many of them had massive loans that they couldn't pay off, such as mortgages, student debt, and other outstanding loans. And I know Jordan loves talking about how physicians need to work really hard to pay off their debt and to really move their lives forward. So we reviewed their situation and decided to do the following. We changed their ownership and entity structure. The C Corp stayed the same, but for each physician we worked with, instead of owning their shares individually, we decided to establish S corporations so the income can flow through the S corporation and we can deal with the income there. This first step prevents the massive inflated salaries that these doctors previously had and gives them more power over their income. Then we start implementing some tax strategies once the income flowed to their S corp. We did some entity planning, as we discussed, and then we implemented a reasonable compensation strategy, which sets the salary of the doctors to the point where it is not too high on a W-2 where they're subject to payroll taxes, and also it is not low enough so that the IRS won't come looking for trouble. This involves market research based on each individual case, so it is highly dependent on the physician themselves on what exactly are they doing, how much money they are making, what responsibilities they have, and etc. Next, we determined that this physician would qualify for the Augusta Rule strategy, which was discussed earlier in the webinar. We implemented some employee reimbursement plans and then a home office strategy. We changed these physicians' lives. For this particular physician, his tax bill alone, after tax planning, was $153,383 for both federal and state before considering any withholding. If you compare the before and after, the total tax savings for this one physician was $242,656 in federal and state tax savings. Imagine these tax savings for 5 physicians that we did this for. Not to mention, these savings are perpetual, meaning every year these physicians had similar tax savings because these have been implemented every single year. Since this group of physicians joined us in 2019 and are still with us, we have saved them approximately over $7 million in tax savings over the last 6 years. You can imagine how we have impacted their lives. Their loans are now paid off. They're living very happy lives. They're traveling around the world. They're growing their businesses. This is the power of tax planning. Now, let's move on to our second case study. In this case, we have a urologist who is a solo practitioner. He has been our client for many years. This client's issue was that he has mostly been a high-income W-2 earner, making over $1 million as a urologist. On the side, he was receiving a very low amount of 1099 income, where we can do some planning, but we're limited by the high-income W-2. We told this physician to have us look through his physician contract with his employer to determine if there was any way he can reclassify some of his W-2 income as 1099 income. This is highly dependent on each physician's case, and for this particular physician, this was in fact the case. Without taking this step and without any tax planning, this physician would have paid about $404,732 in taxes before considering any withholding in 2024. Sure enough, the physician came back to us and he was able to begin to classify some of his income as 1099 in 2024. So we established a corporation for this physician and implemented the following tax strategies in this particular case. We have some depreciation from his jet. Yes, this physician owns a small jet, but just to be clear, we did not write off the whole jet. The doctor has a pilot's license and enjoys flying personally, but he also flies with his patients and work colleagues, and he keeps a very detailed flight log. So we take the business use percentage from the flight log, and we're able to depreciate and expense that percentage of all of the jet costs. Then we have some similar strategies that we've talked about: reasonable compensation, the Augusta rule, profit sharing, and home office. This doctor also decided to invest in a charitable donation strategy. If we look at his total tax bill after tax planning, it came out to $225,511 before considering any withholding. The physician's net tax savings in this particular year was about $79,000. That might look off comparing the numbers, but there was some investment that was factored in to achieve these savings. So after considering those events or those investments, this physician saved about $79,000 net. Now, if you're thinking to yourself, how can I get tax planning? You must first understand what qualifies you as a great candidate for tax planning. First, we have our income level. In our tax system, you get progressively taxed more on higher amounts of income. A great rule of thumb to know if you make enough money is not actually to look at your income level, but to look more at your tax liability level. For your reference, we like to look at the second page of the 1040 tax return and the state tax return if you live in a tax state. and look at a specific line that sums up your tax liability for the year before considering withholding. Typically, if this number is around 100,000 and up, which could be slightly below depending on the circumstance, you may be a great candidate for tax planning. The reason we estimate it to $100,000 is because you are likely to be taxed at around 30% and up, considering both federal and state tax rates. This gives each dollar of deductions more bang for your buck, as the expression goes. The difference with a tax deduction and a tax credit is a tax deduction lowers your income, while a tax credit lowers your tax bill dollar for dollar. So if you're taxed at 30%, and you deduct $1, you're saving 30 cents on that dollar. But if your tax rate is lower, like at 20%, each dollar you deduct only saves you 20 cents. That's why it's very valuable to know what is your tax rate, how much tax you're paying, so that we have a good idea of if these tax plans are worth it for you. We also have a style, our own style of how we like to implement tax strategies for you at Tax Planning Boutique. Many people consider stacking strategies to get your tax to $0. While that sounds great, it doesn't apply to everyone, although it definitely happens on a case-by-case basis. If this is your first time doing tax planning, our style is to introduce you to 2 or 3 tax strategies that you may qualify for so that you can see for yourself the beauty of paying less tax. Then after that, we may start introducing you to other strategies based on your risk tolerance. Speaking of risk tolerance, it is important to understand this factor. Each physician or business owner has a risk tolerance when it comes to tax planning. Just to be clear, every single tax strategy out there has a risk for IRS audits. There are definitely less risky strategies compared to others, but each strategy has an opportunity to subject you to an IRS audit. We haven't had that happen to our clients, but it's important to understand what could go wrong. As you may know, IRS audits start by receiving a letter in the mail to prove this deduction. We prepare these documents for you so that you can win your IRS audits. There are higher risk strategies that could likely end up in tax court if you decide to invest in a syndication, for example. In order to determine what tax strategies are great for you, each physician should understand what their risk tolerance is. Are you looking for the safest strategies only and fine with saving some taxes, but not as much as the higher risk strategies? If you do decide to be in a higher and risk tax strategy, are you prepared for an adverse outcome in the worst case in a few years down the line? This is something everyone should understand before diving in. With that being said, how do you actually get tax planning? Well, if you feel that you've outgrown your CPA when it comes to tax planning, this is the first step to take. We start with a tax assessment where we analyze your current situation. We diagnose your tax problems the way your doctor would diagnose a medical problem. The diagnosis takes the form of this tax discovery session. This is where we sit down with you, look over your business and personal tax returns, just like how we discussed earlier in the presentation, and look at any supporting documents. We'll ask a series of questions about your goals and resources. Then we'll diagnose any mistakes and missed opportunities that might be costing you taxes you don't have to pay. Next, the prescription takes the form of a tax planning proposal that introduces you to the tax strategies you're missing. Finally, the tax planning engagement fills the prescription. This includes implementation guides, checklists, forms, templates, and referrals to specialists that you need to put the strategies to work, document them properly, and audit-proof your returns. Then we repeat for next year because every single year is different. You can book a tax discovery session with us at taxplanningBoutique.com/book. We do charge a consultation fee for this session. This is done to give you a more tailored consultation and assessment rather than a general consultation. Thank you for attending this webinar. Here's our direct email if you want to reach out to us for questions at admin@taxplanningBoutique.com. As I mentioned earlier in the webinar, we are offering a discount of my new book, The Ultimate Tax Log, for the next 24 hours. You can buy this book for $9.99, but the value of this book to you could be hundreds, thousands, or even tens of thousands of dollars depending on how you're using this book. Thank you, Jordan, and thanks to the Prudent Plastic Surgeon team, and we're happy to open it up for questions from the audience.
Awesome. Thanks so much, Paul. It was definitely informative as always and some really impressive and cool stuff. I never thought to depreciate my private jet, so just all the more reason to get a private jet. So we'll keep working towards that. Um,
Yeah, it's a goal. It's a goal to hit, right?
yeah, exactly.
Yeah.
Well, I encourage anyone who has questions, please, like I said, raise your virtual hand if you want to share or throw them in the chat. Um, I guess this is a very like basic question, but a lot of times um, will come up in something you kind of covered in a previous webinar, but for those who weren't there, how can doctors like what is the best way you've seen if someone is like I am right now just a W-2 and I feel like it's really limited what I can do with taxes. I guess the two-part question is what should they be doing to make sure that they're actually maximizing tax advantages? And then how can they what creative avenues are available for them to start to use some of these 1099 strategies?
That's a great question, and we do have options for high-income W-2 earners, but the real question that these physicians have to ask themselves is, what are their financial goals? For example, many physicians love investing in real estate, but investing in real estate requires investment, and they need the cash to do that. They need the ability to take the loan. They need the time to actually run the business, etc. It's like investing in a whole nother business. That's one avenue of trying to pay less tax. But when it comes to doing something like that, where you're trying to invest in something like real estate just to lower your tax liability, oftentimes you have to consider the cost benefit to you. So a lot of physicians actually ask me the same question, I'm a high income W-2 earner, and a lot of people tell me, for example, to invest in real estate. And I love real estate. I invest in it myself. And I love doing real estate tax planning. However, if you look at how much cash that you're going to save, you may have big tax savings, but you're also going to be shelling out a bunch of cash for the down payment, for the expenses, especially if this is a brand new business for you. So it really depends on what your financial goals are. And if your goal is to move into real estate, like long term, grow a portfolio, then it's totally worth it because they're going to grow long term, the appreciation, and they're just going to get a lot of experience. There's also options for these high income W-2 earners to invest in, for example, charitable donation strategies. I personally invest in it. Lubna personally invests in it as well. So anything that we recommend, we always disclose, what the risks are because they can have a higher tendency of risk. But it really does depend on their financial goals, which is why we always ask.
Awesome. And then Philip has a question here. Could you touch on your fee structure?
Of course. So we do not have packages because we do custom tax planning for each individual client or each individual physician. And we charge based on the value that we give to you. So basically, if we think that you're a great candidate for tax planning, when it comes to our tax planning proposal, what we will do after we review your situation, we will say, okay, here's an idea, an estimate of how much taxes that we can save for you. Here is the dollar amount, an estimate. And then from there, we will bundle some other services that we offer, like tax preparation, and we will give you one fee where you will be much better off paying us rather than paying the IRS because you will be at a net savings and you'll be very happy. Now, if you're in a case where you think you might be a great candidate for tax planning, but we think after our review that it may be not as much worth it, we will tell you in the discovery session or maybe through a proposal, you know what, this year we don't think that doing tax planning is worth it for you at this time. You're probably better off paying the tax. So we'll outline that all for you, and that's where our fee comes in as well.
Jordan, may I add something about the fees too,
Of
to what
course.
Paul mentioned? Yeah. So what happened is we sent the proposal to the clients, and when we roll our sleeves and start the actual work, if we do not meet what we proposed, we definitely issue a refund, partial refund to the clients, and we adjust our fees down. If we find more than what we proposed, we will give it. If it's small amount, we will, let go and we keep the fees as is. But if there is more room for saving substantial amount, we stop and we communicate with the client and we let them know that there is a room. We might adjust our fees a little bit higher because the savings are, let's say I'm bringing another $50,000, so there will be some savings. It happened with us before that we had groups of physicians. So some of them that we didn't meet the proposed amount of savings, so we issued a refund for them, and they were very happy with that because we cannot charge for value not delivered.
Yeah, no, thank you for sharing that. I think that that's obviously the most value aligned way
It's,
to do
it's
things.
fair, yeah, fair
Yeah.
to both of us, yeah.
All right, Vesna has a question. I'm a solo pediatrician. The structure of my business is an LLC. Would a corporation be better? And I'll extend that to which one. And then Vesna, if Paul has questions for you, I encourage you to you can also pop off your mute or a camera if you feel comfortable.
Sure. So that's a great question, and that's honestly the first step when you're thinking as a solo pediatrician or a solo business owner, and you're making 1099 income. That first decision on whether to be an LLC, whether to be a corporation, the first thing that is I think very valuable to know is even if you are an LLC, you can always elect to be taxed as an whether it's a C corporation or an S corporation. But whether to make that jump, whether to make that decision, you really have to see, okay, how much are your profits? What are your profits going to be in the next couple of years? Because while you elect to be a corporation, whether that's an S corporation or a C corporation, there are, of course, added costs when it comes to being a corporation. You have to file a whole new tax return. You have to run payroll. You have to set up all of these different systems as well, like your retirement. And each of those have fees. And while those fees may be small, a handful of those fees can add up. So it really depends on what exact situation you have and what you're, projecting this year, next year, etc. So sorry to give you a general answer, but it's true. I can't just tell you yes or no.
Yeah, that makes sense. There's obviously a lot that certainly goes into it. Can you talk a little bit about how you kind of manage like audit protection and taking clients through audits and that kind of thing? I know that's by far the number one fear that I hear from other physicians is a lot of times they're not willing to use a strategy solely because of the fear of an audit.
Of course. So luckily for us, we haven't had to bring one of our clients through audit. They have not gotten audited. So that's something that we like to say proudly based on the work. Whenever we claim tax strategies on the tax return, we like to disclose that as well. And everything we do is by the letter of the law. But when it comes to having that fear of getting audited, it's really just something, if you have that fear and you just don't want to participate in that tax strategy, we'll disclose the risk to you up front before we even work together. And if you just have that risk, maybe that strategy isn't for you because not every single strategy is meant for every single person. I'm sure the same can be said for any other types of, finances, like some retirement accounts or some insurances or things like that. So when it comes, if someone ends up being audited, what we do proactively when we file the tax return around that time is we will already prepare these documents and save them in our files because the way IRS audits work is you won't get audited right after you file the tax return. You have to wait a couple of years actually because the IRS has 3 years at minimum to audit your tax return for each year. And if you're getting audited 2 years after we filed the tax return, most people, other people, will panic, stress out, try to go back 2 years in their emails or 3 years in their emails and try to find the documents so that they can try to win their audit and try to defend their case. But what we do is we like to do that up front before, around the time we file the tax return. And we're very confident in everything that we offer for our clients. So we're not afraid of the IRS. And while we're not afraid of them, we do respect the rules and we're not saying to be unreasonably aggressive. And by the way, a lot of IRS auditors and a lot of IRS agents, they note exactly what happens when you send them the letter what that first move is. So if the first move for us is going to be, all right, here's our proof of this deduction, or here's our proof of this strategy, they're going to take that into consideration that we were prepared and it's most likely legit. But if someone, someone else is not ready for that audit and it's taking them a long time to get back to them and things like that, they actually do note that. That's what we do for our clients. And as I said, we have all those documents prepared.
Awesome. Thank you. A private message just came through to me. Could you provide some general statement about how often these strategies work for typical hospital employed physicians who don't have any business as corporations? So that's a little bit like we were talking earlier, but a little more constrained there.
Yeah, I mean, we do offer some opportunities for high-income W-2 earners. It really depends on what they want to invest in. So, as I mentioned, some people like to do real estate. Some people like to get into the charitable donation strategies. We do have other opportunities too. It just depends on what their goals are and what they want to do.
Awesome. Do you do do you do tax planning for retired physicians?
Yes, we definitely do. It really does depend on like what they're doing, like how are they making their money. So we do have other non-physician clients. Of course, we have real estate professionals, we have investors with massive portfolios. We have people in different types of industries that we also service. So we're not limited to physicians. That's just something that we specialize in.
Awesome. And then Vesna's asking, where are you located? Is the consultation done virtually?
So yes, the consultation is done virtually. We are located in Metro Detroit. Our city is called Troy. That's where our office is. But we have clients nationwide. While we're in Michigan, we do have some local clients. Like for example, the Cardiology group is a local client. But we have many clients in California, North Carolina, Ohio, Florida. So we're not limited by our jurisdiction, I guess, in terms of the where our state is, but our jurisdiction is the 50 states in the United States. So, yes, we have virtual clients all the time.
Awesome. And I will say, even though I'm a big University of Connecticut basketball fan, congratulations, University of Michigan, on their
Oh, thanks.
national championship.
Thanks. Yeah.
Um,
Michigan is so great, honestly. Even the state,
um, yeah, well, less taxes in New York, that is for sure.
right?
Um, I guess to kind of close out, what is the best way for folks who have questions, are interested in scheduling a session, learning more about what strategies they could implement? What's the best way to get in touch with you guys?
Sure. So if you're looking for this exact consultation, this exact assessment of your tax situation, the best thing to do is go on our website at taxplanningboutique.com/book, and you'll be able to schedule a tax discovery session with either myself or with Lubna, the founder of Tax Planning Boutique. And if you have any, small questions, you're not sure of how we operate, our email is there at admin@taxplanningboutique.com and we'll be happy to answer some questions. And if needed, we can also direct you to the website as well.
Amazing. Thank you, Paul. Thank you, Lubna. But for all of the insights that you shared, incredible case studies, and I'm always just I think I have so much respect for your passion for this and helping physicians, and I just think that's really fantastic. So thank you everyone who joined live, anyone who's watching the replay, and we'll also be sending a follow-up email with information as well as contact information also. So thank you all so much, and have a great night.
Thank you so much.
Thank you, Jordan. Have a good day.